Welcome back. We are now in segment 6.2, and in this segment we will be discussing about capital. So please recall, we have already seen the blank format of CMA data, and we are now starting into the liability side of the balance sheet, right? So we already seen under the liability sides, there are many items, but they're broadly classified under the owner's funds, right? And then we have the term liabilities and the current liabilities, right? These are the three major headings under which we are going to classify the liabilities items of balance sheet. Either there will be funds belonging to the owners, or there will be outside funds, right? This is the owner's funds, and this is the outside funds. Within outside funds, we have the either it could be a term liability or a current liability. We'll see what is the distinction between each of them as we go forward. But this is the three major headings. When you see a CMA data, right? When you see a CMA data, you are going to see this broad headings, right? I have the owner's funds, right? I have the term liabilities and the current liabilities, and within this you have various items, right? So when you're giving a balance sheet, you will take each item and put it either in the owner's funds or in the term liability or current liability. It will go into one of these three major headings, right? So all the items, all the liability items on the balance sheet will ultimately be part of one of these three major headings, right? Capital is the contribution, right? It's the contribution of the owner in the business. You should first of all understand why banks insist on margin. You have to understand the term margin. Margin is nothing but the promoter's contribution. We'll first of all see why banks insist on margins, right? So you might have observed that in your banking job you have come across various loans, such as housing loans, right? Vehicle loans, various loans you have come across. Take for example a car loan, right? Or a bike loan, whatever it is. You'll see that banks stipulate something known as margin. If the cost of the bike, say for example the cost of the bike, or let us say the car is 5 lakhs, is the cost of the car. So when a person applies for a car loan, what bank says, we will not give you the entire 5 lakhs, isn't it? No bank will ever provide the entire cost of the asset as a loan. So what they'll say, you pay your margin, you pay something from your side, like let it be, the amount is different. See, whether you pay a 20% or 50%, 10%, it varies from banks to bank. That is different. But there will be some amount the banks will be insisting. You say, you bring in as your margin. The balance will be paying. For example, if the bank says, out of this 5 lakhs, right? Out of this 5 lakhs, you pay 50,000, right? That is 10%. And the bank will give you a loan of 4.5 lakhs, right? This 50,000 is what is known as margin, right? So why do banks insist on this margin? This margin is universal, right? This margin is universal for all banking loans, right? Whether it's for personal loans such as vehicle loans and housing loans, or it's even for corporate loans, as you're going to see for term loans, working capital, any credit facility extended by banks insist on what is known as margin. So why do banks sanction loans with margin? Why do they insist on margin? What if there is no margin, right? Let us see what if there is no margin. So say for example, you and 4 other colleagues, right? Total 5 colleagues are there, right? You yourself and 4 other colleagues of yours have some funds with you, right? And you're contemplating what to do with these funds. So I come in, right? I'm the 6th person. I come in and say, I have a business idea, right? I say I have a business idea. You have the funds. I have a business idea. And using this idea, let us promote a small business using these funds. And whatever profits, let us share equally, right? So that is the proposition I put forward, right? So then you 5 people will be asking me, so what do you put in? Like, for example, each of you has funds of 1 lakh, right? So total you have 5 lakhs, right? So you ask me, so how much you will put in? So I will say I will put in 0. See, my idea, my business idea itself is my investment. I'm not going to pay anything, right? So are you going to accept this? Are you going to accept this proposition where I say I will not invest in anything? It's just my idea, right? But you bringing them out. Let us run the business together, and any profits let us share in an equal proportion, like 1/6 of the profit each person will get. So is this acceptable to you? It for some of you, not all of you, for some of you, it might seem to be reasonable, right? Because in a way, my idea is my investment. I'm not going to pay anything, right? So are you going to accept this? Are you going to So some of you, not I'm saying all of you, but some of you might say it's all right. We have funds, you have a business idea. We cannot quantify this business idea, but it's also valuable. So instead of money, you're bringing a business idea. If this clicks, you are going to have profits. So say for example, we'll make a amount of 6 lakhs. So happily, each of us is going to split that 6 lakhs into, so each one will get 1 lakh. So this is a good idea. If it clicks, everything's fine. The problem is you're looking from the angle if the business idea is successful. You are thinking from the angle if the business idea is successful, it will generate some 6 lakhs and each of one will get 1 lakhs besides our capital. But the problem is you are assuming it is successful. What if the idea is a failure? We implement it, right? We implement this idea and it fails. Let us assume instead of making profit, we have incurred a loss of 5 lakhs. We didn't make profit, but we actually incurred a loss of 5 lakhs. So in this case, who stands to lose, right? Who are the persons who are going to lose? See, I have not brought in even a single rupee. The 5 lakhs is you and your colleagues had, that 5 lakhs is going to be vanished, right? Your initial investment which you put in 5 lakhs, because the business had made a loss, you are going to bear that loss. I have nothing to lose because I never pumped in any amount into this business. If it wins, if the business is successful, then I will come into the picture. I will come and take my share of profit. But if it loses, if the business side is a failure, I have nothing to lose. I silently walk away. You are the ones who are going to bear the loss. Now you can answer the question well, whether this is acceptable. Earlier, some of you might have said it is acceptable only because you are assuming that it was successful. If it's successful, everything is fine. Right? Then you can share your profit. But what if it is a failure? At the beginning of the venture, you don't know whether it's going to be success or a failure. This is where the concept of risk comes in. A business owner or the promoters are taking a risk here. In any business venture, forget about this example, any business venture, the promoters are taking a risk. They don't know whether the business will be a success or a failure. Right? See, there are various lenders to a business. There are various lenders to a business who provides funds. Various people. See, the promoters are just one of the people who are going to provide funds to this business. But banks will provide funds. Right? There will be some creditors. Various other outside parties will be providing funds. So put together, so the company using these funds starts the business and does some activity and generates some either revenue or loss, right? Ultimately, all of these people expect to get back how much they provided. They're not here to share the profit, right? If you're as a bank, you have lent some 10 lakhs. Ultimately, you are interested in recovering this 10 lakhs plus some interest, right? You're not here to share the profit. See, you are interested in only getting back the 10 lakhs. Same is the case with other outside parties. But the promoters are saying, whatever is the profit we are going to take. But at the same time, they're also saying, whatever is the loss we are going to take. See, that is the risk here. The risk is being taken only by the promoters. Then there's no risk for the banks and creditors in the sense that if the business doesn't fail, they will lose their loan. But then they have some collateral to recover. They have some other arrangements. For the promoters, the first persons to take a hit, the first persons to bear the loss will be the promoters. So they are taking a risk here. So if it is a success, they are the ones who are going to enjoy. If it's a loss also, they are the ones who are going to bear it. So when in any business venture, if the promoters say we are not going to invest anything and we are going to run the business purely by outside funds, right? A company, the promoters will say, you all give me funds, but I will not bring in anything. I will manage the business with these funds. And if there is any profit, let us share together. But if there is a loss, I will not come into the picture. I will not take any loss. This is totally unacceptable. No person will accept this, right? The reason why banks insist on margin is to ensure the promoters have a stake, right? They have a interest in the business. See, they should be interested in running the business, right? They should have a fear that if tomorrow something goes wrong, if the business fails, their money is going to lose. It's also their money. Some part of their money is also there, and they will also stand to lose. If they don't have this fear, if they're running purely on outside funds, if the business loses, if something happens, they've got nothing to lose, right? It's precisely for this reason you have to ensure, right? To ensure there is the promoter's stake, the promoter's interest. You're going to insist on margin. Banks are going to insist on margin. Similarly, the case, take for example, an individual account. We're taking here a company. Let us take a case of an individual loan. Take for example a housing loan, right? Bank has given a housing loan. The cost of this house is say 20 lakhs. Now bank has provided entire 20 lakhs as a loan without insisting any margin from the borrower, right? So what happens here? Repayment is based on some assumptions, right? So the bank has sanctioned this loan based on the repayment. Say this person is a salaried employer, salaried employee, and he is going to fix some EMI. So every month he is going to pay some 10,000 or something. He has fixed the EMI. So let us assume that everything is fine, right? Everything is fine. This employee is doing well. He is getting salary every month. So every month he is paying 10,000. At the end of the tenure, whatever is the tenure, he is going to repay this entire amount, and the house is going to become his. Now the house is become his, right? So the bank has recovered his loan. The bank is happy. It's recovered his loan, right? The person has got his house. He's repaid the loan. That is fine. That is the happy scenario, right? We are taking a happy scenario. What if something goes wrong? See, what if something goes wrong, right? So this person, something happened. This person lost the job. He's unable to pay the EMIs. So he's come midway. Say out of this 20 lakhs, he has paid some 5 lakhs, right? Plus interest, whatever, right? Out of the principal, he has repaid so far 5 lakhs, and then he stopped paying due to various reasons. He is now unable to pay the EMIs. Now, what is the interest of this borrower? Now, what did this borrower has to lose, right? What does this borrower has to lose? So he's got nothing to lose. Now, if the bank wants to recover its loan of 20 lakhs, what is it going to do? It's going to sell this. The bank is going to sell this house, and it's going to recover 20 lakhs in the market. Now, banks cannot take 20 lakhs, right? The banks will not take 20 lakhs because out of that, the outstanding is only 15 lakhs because the borrower already paid 5 lakhs. So banks are going to take the outstanding amount, 15 lakhs, right? So out of the 15 lakhs, they will take the 5 lakhs and give the borrower 5 lakhs. He got back his 5 lakhs. Whatever he paid, he's going to get back. So what is the risk here? If everything goes well, right, without his margin, he's going to enjoy a house. If for some reason he's unable to pay it, he's going to get back his amount. There's no risk here. His interest is not there, right? Let's take the example of a small SSI unit, right? Now we are a small SSI unit. This is into manufacturing. It's got a factory, right? It is going to manufacture some goods. Now the cost of this project is 25 lakhs, right? The bank has sanctioned the entire 25 lakhs as a loan. His interest is 0. So the idea is, out of these 25 lakhs, the company is going to generate some profits every year, and out of this profits is going to repay the loan step by step. Say the tenure of the loan is 5 years, right? Everything is going well, fine. Something goes wrong and the business is not generating profits. Who loses here, right? If the project stops midway, say for example, out of the term loan 25 lakhs, the bank has disbursed so far 20 lakhs, right? The project is some 80% completed, and now the project is halted due to various reasons, right? Various reasons the project is halted. Now whose funds are blocked in this 20 lakhs? Entire bank loans. The bank funds are totally blocked. The promoter has got nothing to do with it. So if the business fails, he'll just silently walk away from the business. It is the bank's funds who are locked in, right? If now the action is to be taken from the promoter, but he has no interest, he'll walk away. But they say, for example, out of this, if the bank had already insisted on some margin, out of this 25 lakhs, bank has sanctioned only 20 lakhs, right? And promoter was asked to bring in 5 lakhs. Now, for example, out of this 20 lakhs, if the bank has disbursed some 15 lakhs, the borrower must have brought in some margin of 3 lakhs. Now, if something goes wrong, if the project is halt, the promoter will be doing everything possible to bring the business back, to bring the unit back on track. Now, his interest is there. See, in the earlier scenario, he doesn't have that much interest because he's got nothing to lose. His funds are in no way blocked. If the business does well, he generates profits, that's fine. If nothing happens, he's going to walk away silently, right? But here now he's got an interest. Now he's got an interest, right? So therefore, banks always insist on what is known as margin. We insist margin to ensure that the borrowers have a stake in the business, right? They have an interest in running the business. So to put it simply, why we insist on margin? To share the risk and to have the stake in the business. Remember the example? When 5 of your colleagues have invested 5 lakhs, I come in as a 6th person and say, I will not invest anything. If you make profit, let us share the profit, I'm saying. But if you make a loss, I'm not going to take any loss. That's not acceptable. So the same concept applies in personal loans or corporate loans or any loans. Without your margin, banks will not come into the picture. Some margin. See, the amount may be even 5%. but some margin they'll be insisting to bring in, because only then you will be having, as a promoter, you'll be having a stake in the business, and banks want to ensure the promoters have a stake. They have an interest in running the company. So without bringing any promoter, without promoters contribution, even a single rupee, not going to extend any loan. So banks always insist on margin. So that capital, right, that contribution, the promoter's contribution, the initial promoter's contribution is known as capital, right? Capital is the promoter's contribution at the starting of the business. Whatever he is initially invested is known as capital. In the case of proprietorship firms, it's known as proprietor's capital. In the case of partnership firms, it's known as partner's capital, right? And in the case of companies, it's known as paid up capital, right? This is the initial investment. Initially, at the starting of the company, whatever the amount the company has, the promoters have pumped in. Subsequently, they can infuse additional capital. So that is different. So initially the paid up capital was 10 lakhs. We'll discuss what is paid up capital shortly. So initially at the start of the business, the promoters have pumped in 10 lakhs. After 1 or 2 years, the business is expanding. They need to invest more and more. Then they can pump in additional funds. So now the paid up capital has increased to 20 lakhs. That can happen, right? That can happen. So whatever it is, capital is the contribution of the owners. The contribution of the owners in the business is known as capital. So from a company point of view, when we are going to see in a later chapter, in chapter 16, that the constitution can be a various. For a business establishment, the constitution can be a proprietorship firm, it can be a partnership firm, it can be a private limited company or a public limited company. When it is a company, right? When it is a company, we have the concepts of authorized capital and paid up capital. In the case of proprietorship and partnership firms, we don't have any, because there are no shares, right? There are no shares to be subscribed. So the concept of capital, paid up capital doesn't arise. But in the case of companies, we have a concept of authorized capital and paid up capital. So authorized capital means, right? Please remember, authorized capital is the maximum, that is the ceiling amount up to which a company can raise funds. So the authorized capital is say 100 lakhs. So the promoters all put together can pump in a maximum of 100 lakhs. They cannot invest anything more than 100 lakhs, right? If they want, you can amend the authorized capital. You can increase the authorized capital by making a suitable application to the register of companies, and you can get it amended, right? It's not that this 100 lakhs throughout the life of the company, it has to stay 100 lakhs. Tomorrow, if the business improves and the promoters need to infuse additional capital, they can increase the authorized capital, say to 250 lakhs, and then they will pump in the additional amount. It's not like you have to forever stay with this 100 lakhs, but once at any point of time, if the authorized capital is 100 lakhs, at that point of time, they cannot, if today the authorized capital is 100 lakhs, today they cannot invest more than 100 lakhs. To infuse initial capital, they need to increase the authorized capital. So authorized capital is the ceiling, the maximum amount of funds the promoters can pump in. What is paid up capital? Paid up capital is the actual capital that the promoters have brought in. So even though the authorized capital is 100 lakhs, you need not bring in the entire 100 lakhs. This is just the ceiling. You need not bring in 100 lakhs. For example, the promoters have brought in only 25 lakhs. This will be the paid up capital. Authorized capital is the ceiling, the maximum amount up to which you can go, right? But out of this, you have raised only 25 lakhs. Fine, that is acceptable. There's nothing wrong with it. So 25 lakhs will be the paid up capital. Paid up capital is actually the actual capital contributed by the promoters so far. There are actually many other types of capital, right? So you have something called call up capital. You have something called issued capital. There's something called subscribed capital. All of these are not that relevant to you, right? From a banker point of view, all of those, they are not that relevant. These are the two terms you need to remember: authorized capital and paid up capital. One very important thing that you need to look out for when analyzing balance sheets, and this is a very important point. Whenever you analyze balance sheets, there is very important with regard to capital. There is one point that you need to absolutely ensure, that is whether the envisaged capital was brought in or not. Right? You have to go to the previous sanction file, see whether the envisaged capital. So what happens is, take for example, as on 31/3/2012, right? A particular company had this sort of balance sheet. So the promoters had invested some 10 lakhs into the business. They have no outside loans. There are no outside loans. Entire funds were brought in by the promoters themselves. They have no outside borrowings from any party, banks, creditors, no outside borrowing. So entire funds were pumped in by the promoters. So they use these 10 lakhs to purchase some land and machinery, land and building of 5 lakhs, machinery 2 lakhs, and there's some inventory up to 3 lakhs. So totally they have 10 lakhs. So this 10 lakhs was used like this, right? So this is the position as on 31/3/2012. So now the company, what they did, they plan to purchase an additional machine of 5 lakhs. So the cost of this machine, additional machine, is 5 lakhs. And now the company proposed to, the promoters now have no more additional funds to infuse. They are cash tight. They cannot infuse additional capital. So then they have approached banks saying, we need to purchase a machine of 5 lakhs. Please give us a loan of 3.5 lakhs. Right? They're applying a loan of 3.5 lakhs from the bank, and 1.5 lakhs they'll bring in as the additional capital. So the promoters cannot bring in the entire 5 lakhs of their own from their own sources. So they're saying we can bring only 1.5 lakhs. So please give us a loan of 3.5 lakhs. So the bank has sanctioned the loan. Let us assume that the bank has sanctioned this loan of 3.5 lakhs. Right? So one year has passed, 31/3/2012, and now 1 year has passed. Now we have the balance sheet available as on the next year, that is 31/3/2013. So when you see the balance sheet of this year, next year balance sheet, you can see that the company has purchased this 5 lakhs machinery. Let us assume rest of the figures are same, right? So still the land and building is 5 lakhs. We are assuming there is no depreciation of the building. Again, no depreciation on the old machinery. Let us assume that's for simplicity. Maybe inventory has increased to 5 lakhs. So this is the position. Importantly, the machinery which the bank has sanctioned loan, that 5 lakhs is appearing. But let us see at the funding side. So what the promoters earlier said was, originally already they had a capital of 10 lakhs as on this date. And they said, out of the 5 lakhs, give us a loan of 3.5 lakhs. We will bring in an additional margin of 1.5 lakhs. So actually, they should have brought in, the capital should have been 11.5 lakhs as on 31/3/2013. Assuming that the loan is fully disbursed. And the loan was fully disbursed because, see that the loan was fully disbursed. See, earlier the company had no outside borrowings. It has only 10 lakhs. Now a new item called loan is appearing, 3.5 lakhs. This is the loan which the bank has sanctioned. So they have fully availed the loan, purchase this machinery. But if you see the margin, the capital had to be 11.5 lakhs, but it's only 11 lakhs. You see this point? The promoter said, please give us a loan of 3.5 lakhs to purchase a machinery of 5 lakhs. We will bring in 1.5 lakhs. So next year when you saw the balance sheet, you are noticing that the loan was fully availed. 3.5 lakhs is appearing. Fine. The machinery is also purchased, 5 lakhs. The new machinery, 5 lakhs is appearing. But this 1.5 lakhs was not brought into the full extent. Originally the capital was 10 lakhs. They had to bring in 1.5 lakhs. So the capital had to be 11.5 lakhs as on 31/3/2013. But what you're seeing is actually it is only 11 lakhs. So there is a shortfall of 0.5 lakhs. The promoters didn't bring in the envisaged capital, right? Proportionate to the loan. The loan was fully disbursed, but the capital which they promised, they did not bring it. This is a very important point you have to keep in mind. This is a simple balance sheet, right? This is a very simple balance sheet with very few items, but the concept is very similar. You sanction especially a term loan, right? This is relevant also for working capital, but especially for term loans. You sanction a term loan for a company. Term loan we will see in a later chapter, right? Term loan is something called a project cost. So you have a project cost. And how the project cost is going to be financed will be given in something known as the means of finance. So say for example the company has arrived at a project cost of 200 crores. And the means of finance is given like we'll give a capital. There is some unsecured loans, some internal accruals, right? A bank loan, right? So various sources the company has said this is how we are going to meet the 200 crores. Now once the project is implemented, let us assume this project is implemented in say 6 to 8 months. So by the next year's balance sheet, this project is completely implemented. Let us assume that the project is completely implemented and the loan is fully drawn. So if the bank loan is completely drawn, say for example out there is 200 lakhs, 150 is the bank loan. So the capital is 30 lakhs, unsecured loan is maybe 10 lakhs and internal accrual is 10 lakhs. Let's assume this is how the 200 lakhs was proposed to be met, right? The cost of project cost of 200 lakhs, this is how it's going to be met. The bank loan has been fully availed, 150 lakhs, which means the promoter should have brought this 50 lakhs also. But if you see the balance sheet of the next year, okay, the profit need not be exactly brought in this breakup 30, 10 and 10. For example, if the company couldn't make profit of 10 lakhs, the promoters themselves could bring in additional, instead of 30 they can bring 40, whatever it is. Total put together they have to bring that 50 lakhs margin. But if you see the next year's balance sheet, if the total of this capital unsecured loans, the additional capital which they infused, the additional unsecured loans which they raised, and the internal accruals for this project, if it is less than 50 lakhs, then you need to be worried because the promoters have not brought in their envisaged capital. Please always refer to the previous sanction. See, don't start a proposal, right? Especially if the company has prior credit facilities. If it's an existing company, It has already have some past credit facilities. Never start with the papers the company submit. The company submits some project report, right? They have the project report, some application. You don't start with them directly. Company submits the project report, some CMA data, some financial projection, some application. You don't start with it directly. You first of all go to the previous sanction, especially when the company is already sanctioned a term loan recently, say in the past 1 or 2 years, right? You please go to the previous sanction and see what was the project cost. How the company promised is going to meet that project cost, and now see first of all whether this project is completed. Because if the project is not completed, maybe the entire loan was not disbursed, and therefore entire capital was not brought in as of that date. That is okay. But even then proportionate margin has to be brought in, which we'll discuss later. But assuming for the moment that the project is completed and the loan was fully availed, the promoter's margin should also have been, the envisaged capital, right, should have been brought in. And where do you get that? You'll get it in the next balance sheet. So you take the balance sheet at that earlier when the company actually applied the loan. So take for example 31/3/2012, the company was sanctioned a term loan of 50 crores. This was towards financing a project of 80 crores. The project cost is 80 crores. This was proposed to be financed by a bank loan of 50 crores, right? And promoter's capital of 30 crores. Let us have only these two items, right? At the next balance sheet date, assuming that the project is completed, right? Let us assume that the project is completed during the financial year 2012-13. So by 31/3/2013, when the balance sheet was ready, this project is already completed. Then when you see the balance sheet as on 31/3/2013, right? What you have to do when you get a proposal in this financial year, let us assume that you got a proposal from this company, either for working capital renewal or enhancement or another term loan, whatever it is. You please refer to the previous file, right? Please go to the previous file, refer to the pages, see what was the plan of the company then, what was the project cost they thought of, what are the sources. And now if you see that the loan was fully disbursed, the project was completed, if the company confirms that the project was completed and the loan was fully disbursed, then the promoter's contribution, the capital should have been brought in. So now in this balance sheet, this 30 crores increase should be reflected. Sometimes the capital entirely it might not be having brought in the form of capital. There might be some unsecured loan. So whatever is the combination, the promoter's contribution should be 30 crores because they fully avail the loan of 50 crores. So if there is a shortfall, this is a serious nature. You have to question it immediately. Immediately you have to question it. And this shortfall has to be made good. See, I'll ask you a question. The project was completed. 80 crores was spent. So 80 crores was spent. 50 crores bank loan was availed. So 30 crores was already incurred. Since the project was completed, 30 crores was definitely spent. But the promoters didn't bring in the entire 30 crores. They brought in only 20 crores. So who financed that balance 10 crores? That is why we'll get to this when we discuss about diversion of funds, right? There is a concept which we'll discuss later, diversion of funds. This is a serious nature. See, this is precisely for this nature. You have to dig in deep. The reason why I'm telling you to go to the previous file, check what is the project cost, ensure that the promoters have brought in the envisaged capital to ensure that there is no diversion of funds. The project was completed without bringing the promoter's capital means some other funds meant for some other purpose. For example, working capital funds might have been diverted to this purpose. See, when the project was completed, 80 crores was spent, out of which 50 crores bank has lent, and this 30 crores was spent, but promoters didn't bring in the 30 crores. They brought on 20 crores, but still the project was completed. How it was completed? So somebody brought in the 10 crores. So who financed this 10 crores? Some funds which were meant for some other purpose was diverted to this project, and that is a serious nature. See, we have to question that. We are going to discuss it when we come to the concept of diversion of funds. But for the moment, please ensure that one of the first things that you need to look into the capital. When you look at the item of capital, whenever you see the item of capital, a very important point you have to keep in mind is whether the envisaged capital was brought in. This is especially true when a term loan was sanctioned in the recent 1 or 2 years, right? And the project was recently completed, right? You have to see this. If the project is under the stage of implementation, for example, the project was, as on the date of receiving this balance sheet, 75% was completed. So out of the 50 crores term loan, the project cost was 80 crores, 50 is the bank loan and 30 is the promoter's contribution. If the project was only 75% completed, right, and the bank loan was only, the company could avail only 38 crores. This is still under progress, right? The project is only 75% completed, and so far the company has availed only 38 crores. Then proportionately, right, since 75% was completed, 75% of the loan was availed, the promoter should have brought in around 20 crores of their capital. See, proportionately. So what we are saying, proportionate margin had to be brought in. If not the entire margin, Entire margin will come into picture when the project is completed and the loan was fully availed. If the loan is not fully availed, at least to the extent that is proportionate to the loan disbursement, the margin has to be brought in proportionately. So you have to always ensure that the margin, the promoter's margin, is there in the business. If the project is completely 100% complete, then the entire margin should have been brought in. If it is partially completed, whatever is the proportionate margin should have been brought in. You have to always ensure that the margin of the borrowers is in no way diluted. Whatever the margin the bank has stipulated, the bank has some policy guidelines, right? It will say for this particular borrower in this activity we will have a margin, let us have a margin of 25%. So this is the policy. This margin is around the basic of the risk perception. So for this category of borrower, for this particular asset which you are financing, for example, land is a risky asset to be financed. Maybe if machinery is a comparatively a lesser risk. So based on various factors, the bank has stipulated a policy for this particular activity. We have a 25% margin. You have to ensure as a credit officer that this is adhered to. In no way this margin should be diluted, right? Based on this 25% margin, if the promoter's contribution worked out to be 10 lakhs, you have to ensure that the promoter is brought in this 10 lakhs at any cost. This should not be any dilution, because once it is diluted and the project was completed, it means there was some diversion of funds, and that is a serious issue, right? You should also note that if you're not vigilant, right, serious frauds can happen in the case of capital. See, what we earlier said was diversion is one issue could have happened if the envisaged capital was not brought in. So how the project was completed, maybe some other funds meant for some other purpose were diverted. So that is a serious issue which we discuss. But even more serious frauds can happen if you are not vigilant as a credit officer. I'll give you an example. Say for example, a machinery whose cost is said 100 lakhs, right? The cost of the machinery is 100 lakhs, and the margin as per the bank stipulation, the margin is 25%. So when the company has approached for loan of 75 lakhs was sanctioned to this borrower, and the margin is 25%, 25 lakhs. So a company has approached the bank for sanction of a term loan of 75 lakhs, and it was sanctioned. This is sanctioned, right? So how does the bank check whether the cost of the machine is 100 lakhs? See, the bank is not into manufacture of this machine. It doesn't know the cost of this machine. I mean, this is a separate company that is manufacturing. There's some machinery supplier which is manufacturing this, who is manufacturing this machine, and the company is coming and saying, please give us 75 lakhs. The company is coming and saying that the cost of the machine is 100 lakhs. So how are you going to believe it is 100 lakhs? So if the company comes and say, this is 200 lakhs, please give me 25% of this. Please give me 75%. That is 150 lakhs. Are you going to give? Right? So the same machinery, some other borrower comes and say, this is costing 500 lakhs. Please give me 75% loan amount. So are you going to give 375 lakhs? So how are you going to believe the customer when he gives a application, a bank application? So your bank has a approved format. He just fills in the columns saying, this is the cost of the machine, please give me 7%. So how are you going to believe the customer? So you don't believe the customer. So you insist on what are known as quotations. So you insist on quotations from the machinery supplier. And in case of construction, civil constructions, you'll have a civil estimate. So engineer will be giving a civil estimate. He's saying for this construction, for so many SFT, so for this total construction, this is the cost, say 25 lakhs. This is the construction. Or he'll be saying, if it is a machine, so these are the machines, these are the quantity, this is the total amount. So if it is a machine, there will be a quotation that will be supplied by the machinery supplier, and if it is a construction, it will be a civil estimate that will be provided by the engineer. So once we have these independent documents, these are not provided by the company, these are provided some the suppliers, right? The machinery suppliers and the constructor. So then we'll have a confidence, and then we'll accept. So now if the company backs up this claim by a quotation, then we'll see, okay, so we believe that this is 100 lakhs. We'll give 75%. So say we'll sanction a loan of 75 lakhs, and you bring in your margin of 25 lakhs. Fine. So now let us look at a fraud that can take place. So you're a company with malafide intentions. You want to dupe the bank. So you don't want to bring in your margin of 25 lakhs. You want to purchase this machine without spending even a single rupee. So what you do? So you know that the bank trusts the quotations. So this quotation is supplied by the machinery supplier. So you tie up with this machinery supplier, right? So the company and the machinery supplier ties up. So now the supplier will be giving a a quotation. Now the quotation, he'll say the machine cost is 200 lakhs. So now as a banker you accept this, right? You trust the quotation, and now you sanction a loan with the margin of 25%. That is, you insist on a margin of 50 lakhs and you sanction a loan of 150 lakhs, right? This is the loan component and this is the margin component. So then what you do, you issue a DD, right? You issue a DD for 200 lakhs. You debit the loan account, you sanction that 150 lakhs, you debit that 150 lakhs. You ask the borrower to bring in his 50 lakhs, maybe he has it already in his current account. You will debit his account, and together you will issue a DD of 200 lakhs to in the name of the machinery supplier, right? So since the company and the supplier are in collusion, so what the supplier will do, he will take now he's got 200 lakhs, right? But the machinery cost is only 100 lakhs, right? The machinery cost is only 100 lakhs. So what he does, he keeps his 100 lakhs. He's only interested in his machine. Let us assume there is no commission deal between the party and the machinery supplier. Let us assume the machinery supplier is doing this only for the sake of his business. So to get this sale of 100 lakhs. So this person will keep his 100 lakhs, and the remaining 100 lakhs he will send it back to the party, right? But the party actually, for issuing this DD, for the bank to issue his DD, the bank has called for a margin of 50 lakhs. So already has spent some 50 lakhs. So deducting this 50 lakhs, now he's got this 100 lakhs. He's actually made a profit of 50 lakhs. You see here, first of all, he did not pay any margin. His margin is there, is not in the business, right? Because originally the cost of the machine is 100 lakhs, whereas bank has sanctioned 150 lakhs. So his margin is not there. Moreover, bank's funds of 50 lakhs was siphoned off. You see here, when the cost of the machine is only 100 lakhs, bank has given 150 lakhs. So due to a deal between the party and the machinery supplier, the 150 out of the 150, 100 lakhs has gone to the recovery of the machine. The supplier has taken 100 lakhs, and the balance 50 has gone back to the party. So this is a fraud which you need to be vigilant of. I'm not saying that a 100 lakhs machine the supplier will be a very exaggerated case. Maybe that sort of that sort of thing may not happen. But the concept is the point I'm trying to tell is, don't go blindly by the quotations and the civil estimates, because if they hike this, if the original cost is hiked, if there is some understanding between the party and the supplier, if this is given for a higher amount, thereby the borrower margin will come down. Remember we're discussing the concept of capital. The borrower margin will come down, right? The margin which was stipulated will not be there in the system. And moreover, there may be the risk where not just the margin is not there, maybe bank's funds are siphoned off. So these sort of things have happened in the past, right? There are customers who indulge in these sort of things. So you have to be very careful. So the point I'm trying to tell is, don't blindly accept the quotations and civil estimates. So the minimum you can do is, at least you have to question them. See, say for example you have received a quotation from the company, from a machinery supplier. So you might have sanctioned a similar machinery to other customers, or if you have not sanctioned, maybe some other in a neighboring circle office, in a neighboring zone, some other your colleague might have sanctioned. Because say for example this is a company engaged in the manufacture of steel, so there might be other steel plants, other steel units in other zones. In your own zone there might be, or in other zones. So why not just pick up a phone and call your colleague in your other zone, right? Or you might be knowing in your very zone other customers who are engaged in this activity, right? Why don't you call? If you don't know any of the steel customers, maybe you know someone engaged in the say some business of fertilizers. So he might be having some contacts. Why don't you just, if you have a good rapport with him, why don't just call him and say, I have this proposal. This is the cost of machinery I'm getting. Do you know any customers who are engaged in this activity? They'll be more than happy to help you. You see, when you ask customers, when you ask companies for their experts, for their advice, they feel very happy, and they'll be more than willing to help you. So they will connect you with somebody who has some expertise in the steel industry. So what I'm saying is, you make some discreet inquiries, right? You please make some discreet inquiries. You need not dash off a letter. Don't write a letter to the company. The machine cost which you're given is 200 lakhs. I'm getting a doubt this is only 100 lakhs. You're trying to cheat the bank. No, I'm not asking you to write a letter. You make some discreet inquiries, and there are various ways in which you can make the inquiries. Don't go blindly by the quotations and the civil estimates. You make some discreet inquiries, either with customers in your zone, or related parties who are engaged in the same activity, right? Or in your neighboring zone, some colleagues will be there. You have some colleagues in your other zones. Your superiors are there. Your boss is there in your very office. your chief manager, maybe your AGM, DGM. There are various ways in which you can ascertain whether the company is trying to dupe the bank or not, right? So always please ensure that the borrower's margin is there in the system. Borrowers will be employing a number of ways in which to avoid the margin, right? They don't want to bring in their margin. They somehow wants to get the loan sanction without investing their funds. That is a situation which you need to be careful of and try to avoid, right? So don't go blindly by quotation civil investments, right? So as a last point in this chapter, let me ask you, can capital decrease? Can capital decrease? So this is a tricky question. So it actually depends on what constitution are you speaking, whether you're speaking it is a proprietorship or a partnership firm or a company. So based on this, we have to answer this question. See, in the case of proprietorship firm or partnership firm, so what happens is the promoters will be bringing some capital, right? So if the business has earned some profit, so you add the profit to the capital. So initially the promoters have brought in funds of 10 lakhs. Now the business has made a profit of 2 lakhs. So you add this to the capital. This gets added to the promoters or the partners capital. So now this becomes 12 lakhs, right? So out of this, the partners can draw some amount for their personal use. So the partners drawings, for example, they have drawn 4 lakhs. So 8 lakhs will be the capital. So this sort of thing does happen in the proprietorship and the partnership accounts. It's not like capital can decrease or increase. It can happen, right? It can move anyway. But in the case of companies, right, please note that this doesn't happen in the case of companies. When you're saying paid up capital is something that if the paid up capital is 100 lakhs, this will not be touched. Throughout the life of the company, this will be like this. It can increase. The promoters can bringing initial funds. This can go to 150 lakhs or 200 lakhs, but this cannot come to 75 lakhs or something. This is the minimum capital. This is the capital which the promoters have already infused. So we spoke of drawings in the case of partnership firm and proprietorship firm. So for example, now the promoters of this company want some benefit out of the profits earned. How? Then in this case you have something called dividend, and this dividend is not going to be paid out of capital. You have a separate item called reserves and surplus. So reserves and into the reserves and surplus, whatever profit the company earns, it will be going into this reserves and surplus. From this reserves and surplus, you can give some dividend, but this capital will not be touched. See, the capital will not. If the promoters want some funds, this capital won't be touched. It will be drawn from the reserves and surplus. So in a company, the capital, that is the paid up capital, will never decrease. That is in the usual case. What I'm saying is usually in the majority of the cases, you're going to see that this does not decrease. It can decrease, right? It can decrease in exceptional cases, but we need a confirmation for the court, right? There are a lot of things that need to go into reduction of capital. For example, you have to, your articles of association actually has to allow that. They have to allow reduction of company. Then you have to pass a special resolution. Then a court confirmation is required. So there's a lot of process involved. Usually you don't, in the normal course, you don't decrease capital. Capital reduction can happen, right? It's not that capital reduction cannot happen. Capital reduction can happen, but it's not something that happens usually. For example, if you remember in 2007, right? In 2007, Colgate Palmolive had decreases capital, right? From 5 rupees share, 5 rupees face value to 1 rupee, I think. It was decreased. Right now we are in 2013-14, and right now there's a proposal by Castrol India, right? There's a proposal by Castrol India to reduce the capital. So these sort of things do happen. Reduction of capital, I'm not saying it never happens. These sort of things can happen, but the normal course, this doesn't happen. So you can take it for granted that in the majority of the balances which you are going to come across in the companies, paid up capital is not going to decrease. It's always going to be same or is going to increase, right? So we have discussed the various points with regard to capital. So we have seen what it actually capital means, what the types of capital. We have seen various issues regarding a capital, right? We have discussed about margin. We have discussed the need to ensure that the envisaged capital was brought in, and what are the frauds that companies can play with regard to capital, right? We have discussed various issues. So in the earlier chapter in P&L account, what we did was for each and every item, as in when we discussed a particular item, say for example sales. So we taken there the example of Maruti Suzuki. And what we did, as in when we discussed a particular point, we straight away went and entered into the CMA data. So what we are going to do in this case of balance sheet is we are going to discuss all points line by line. And at the end, what you are going to do, at one single go, you are going to enter all the items in the CMA data. So this is going to be different from the method we employed in the earlier chapter, right? So regarding the CMA data, please note that we already discussed P&L account, right? We discussed how to enter the various items in the same data. So in case of balance sheet same data, you'll be having liabilities and assets. So now we are discussing the liabilities. We are discussing the various items that can come under the liabilities. The first item we have discussed is the capital. So when you are given a balance sheet and you see an item called paid up capital, right? When you see an item called paid up capital, this amount you have to enter it under the liability side. It is under the liability side. There will be an item called share capital, right? We are going to see this later when you take the example of a company, real life company. So there will be an item called a share capital or paid up capital. You have to enter it here. In a balance sheet, you will also find an amount called authorized capital. So this is irrelevant to us. You're not going to enter authorized capital in the same material, because authorized capital is just the maximum amount of capital that the company can raise. So if the authorized capital is 100 lakhs, but the paid up capital can be only 25 lakhs, right? So this is what we are interested in. So when in a balance sheet, when you're given, please look at the paid up capital and enter that amount in the relevant head under the CMA data, right? With this, we have come to the end of this segment. So in the next segment, we will go to the next item that will appear on the liability side, that is after capital. After capital, we have an item called reserves and surplus. So we'll discuss reserves and surplus in the next segment 6.3, right? See you then.